Welcome, and thanks for joining us. Moss Adams is pleased to present another in our ongoing series of continuing professional education webcasts. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. For example, you can click the File Folder icon to download the group attendance sheet and a PDF copy of today's slides. You can ask our presenter questions during the webcast by clicking Q&A in the bottom left-hand portion of the icon bar and typing in your question. We'll do our best to answer all questions during the presentation or follow up via email. We'll ask polling questions throughout today's presentation. Per the National Association of State Boards of Accountancy Webcast CPE standards, CPE credit will be awarded based on your participation in these polls. To respond to a poll, click the button next to your answer. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. Please have all group members sign the sheet, and please remit only one sheet per group. Also note, today's session will offer you one CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions. CPE credit can be awarded only to participants registered as themselves and is not available to participants who view the on-demand version. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon to open a PDF file you can save to your computer. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances. We're now ready to begin.
Welcome and thanks for joining us. Moss Adams is pleased to present another in our ongoing series of continuing professional education webcasts. I'm Pam Amato Demagayas, moderator for today's webcast. Before we begin the presentation, I'd like to introduce today's presenters, Patty Mayer and Emina Cresswell. Patty provides tax and related tax planning services for not-for-profit organizations. She is a frequent presenter about various nonprofit tax topics at the University of San Diego Nonprofit Governance Symposium, the Salk Institute Tax Seminar on Private Foundations, the Moss Adams webcast series and not-for-profit seminars, and Council on Foundations national and regional meetings, and presenter for the National Business Institute and Stratford Publishing. Emina joined Moss Adams in 2007. She provides and oversees tax compliance and other tax matter consulting services to a wide variety of not-for-profit clients, including public charities, credit unions, utility cooperatives, and other not-for-profit entities. Emina also has extensive experience advising not-for-profit organizations on Form 990 and 990T reporting issues, unrelated business income, related organizations, and taxable subsidiaries. So with that said, I'm going to turn the webcast over to Patty to get things started.
Okay, thank you, Pam. Well, welcome everybody. The agenda for today, we are going to look at updates from the IRS, what we're hearing from Treasury and Capitol Hill, proposals and possible legislation, current developments, and Form 990 changes and clarifications. We have a lot on the agenda, so I hope you'll really enjoy this presentation. We're starting off with our first polling question. And just as a reminder, to get CPE credit, it's based on your participation with the polling. So you'll want to click the button next to your answer that you choose. And we'll leave it open for a few more seconds. Okay. And let's see the results. Okay, great. So we have a few private foundations, public charities, other nonprofit organizations is the highest, a little bit of Moss Adams and others. Well, welcome everybody. So starting with IRS Updates, Tamara Rapata, she is the director of Exempt organizations, and she gave a speech on April 23rd, 2015 in Washington, D.C. And part of what she had to say was just changes in executive leadership. Jeffrey Cooper is now the Director of Rulings and Adjustments, and his background, I found this pretty interesting. He was with the IRS Criminal Investigations, and he is an Air Force retired officer. Margaret, most of her career, she is the Director of Examinations, and most of her career has been in the examination area. Last year, the IRS was realigning everything. They were moving work to Chief Counsel's office for rulings and things. Well, they've done that now, so they're ready to go. They've moved. This is a problem the IRS has been having for a while, where they're getting too much information on personal identifying information, PPI. So organizations are submitting Social Security numbers, and say, for instance, you submit some sort of application or scholarship information, something with the IRS or even your 990. You're attaching brochures, flyers, things like that. Social Security numbers are ending up on those, and what the IRS has to do right now is they have to manually screen this, so it takes a lot of their workforce. So they're hoping to get it automated to be able to scrub the information, but they just want filers to stop doing that. That would help them out. The IRS they're pretty proud of their Select Check program. It's a program, if you're not familiar with it, that you can log on and see if an organization, what is their status? Have they been revoked? Are they a public charity? What type of organization are they for the C3s? It's really easy to get to. You can do irs.gov, or you can even go to Google and just type in Select Check, and it'll take you right there. Another program that they have, it's called the Business Master File Extract, and this one is also available through irs.gov. It's organized by regions and type of operations, so it includes C3s and non-C3s. But what it does, it really has a lot of data. It's in Excel format, and you need to know what the codes are for the columns to have it mean anything to you. But it's not as user-friendly, but it has a lot of really good information. As far as their tax specialists, what they're working on, they're trying to build out structure. They have a knowledge management system that we'll talk about in a couple slides to collect data, share, organize, and they're very concerned about preserving and protecting institutional memory within the IRS. So if we think of that, the IRS is losing a lot of people. There's 24,000 applications of people that want to retire. They don't have authority to rehire people, and when you become an IRS agent, you don't automatically understand all the rules and the laws and how do I examine. So they're looking at a 2 to 3 year training that they'll need to get people up to speed. So the people that are retiring, they're taking about 30 years of experience outside of the IRS. So that's a pretty big deal to them. The IRS has what they call now, it's called a program letter for tax-exempt and government entities. And what they used to do, they used to have a work plan that they would submit every year. They hadn't done it for a couple of years, and part of it was with all the Tea Party political things that were going on, revamping, changing around of people. So now they're back on track, but they've converted it to this program letter. And it's broken out into about 5 categories, and part of their things are they want to continually improve their processes and eliminate waste. So an example of this is last year they released what they call a Form 1023-EZ. That's an application to get exemption recognition with the IRS, but it's an online program. It was pretty simple to fill out. You send it in online. You don't submit your governing documents or anything. And so they thought that was a really good deal for smaller organizations that just wanted to get their exempt status. So they have certain goals. They want to refine things. They're exploring new ways to process and for governmental entities. Then we're to the knowledge management. This is where they're leveraging technical expertise, and they want to be able to transfer this and be able to capture it and use it due to their retiring workforce. So part of what they're doing is they're providing technical assistance to employees for cases and issues without burdensome approvals and procedure requirements. They're trying to make it easier. They want to encourage collaboration, so if there's rulings and agreements that are being done, that people know there's this repository that employees can go to say, oh, you've already ruled on this. Well, what did you say? So trying to give people better access. And they want to make sure the employees take corrective position on behalf of the IRS and the U.S. government. Employee engagement and development is another area that they're concerned about, and I think this goes for a lot of entities and organizations. Employee engagement is huge, and part of it is just the generational differences that we have. You know, the X, Y, Z, all the different generation pools that are out there. What they want to do is strengthen management's visibility, improve transparency within their employees. They want to empower employees. They want to give them ownership of the work process. They want to let them develop things. So it's pushing it over to them and get them vested. They want to have recognition efforts. They want the employees to know how valuable they are to the IRS and the system, and they want to act on their feedback. So those are all good things, and I think a lot of organizations are doing that as well besides the IRS. Okay, this part, data-driven decision-making, this is like a key focus analysis that we should be aware of. What they're looking at, they're developing sophisticated analytical and research capabilities. They want to improve insight. They want to be able to identify trends. They want to predict what are the business issues and what are the demands. So then they'll apply this analytical stuff to improve program effectiveness and an approach to target the high-risk areas. So if we think about data, how they're getting the data, a lot of organizations are required to e-file their returns. So we're helping them out in their data analysis by e-filing. Risk management is another area. They want to be able to identify existing risks, assess it, have responses, know how to leverage it, and all that kind of stuff. So that is their program letter. Other things that Tamara had to say was this is pretty interesting on the examination side of the IRS. So they have budget pressures. They're losing people and they're losing money. They don't have money to spend. What they've done in the past is they've had compliance studies that used a lot of resources. It could be a multi-year study. A good example of that is the college and university report. The study had multiple years, started with correspondence. They picked an audit pool. They had an interim report, final report, multi-year, lots of resources. Well, now they're getting away from that and they're going back to the basics. They are going to focus on data and on issues through queries, filters, identifying patterns and trends. So the IRS is back to their old ways on that. What they're looking at is high risk areas right now in the tax-exempt arena. It's under 4 categories. The first one would be exempt purpose issues. and then the tax gap, employee tax, which typically is your independent contractor versus an employee, or UBIT, which is unrelated business income. Those have always been a high concern, and they're still on the plate. International strategic approach, they're seeing problems with FBAR, which is the reporting requirement of a foreign bank account, where you may have signature authority or you have money in a foreign bank account, and FACTA, which is the Foreign Account Tax Compliance Act, which for individuals they have to report at a certain threshold assets that they have out of the U.S., and then for all entities, there's kind of withholding. They want foreign banks and institutions to report to the U.S. government, and if you in the U.S. have transactions that you're sending money over to some foreign institution, if you don't have the right withholding documentations in place, like the W-8 BEN, then you're required to withhold 30% on any transfer. So they're seeing problems with that. And then always on the forefront of the IRS is protection of assets. They're looking at self-dealing and private enormment. And the last thing is budget reserves for emerging issues. That's a big issue for them because they don't really have a big budget. When kind of the IRS, well, let me start off with this. When the Pension Protection Act of 2006 came out, it was the automatic revocation if an organization didn't file a return 3 years in a row, some sort of 990N electronic, a EZ, or a 990. So what happened when this kicked in, the organizations that lost exempt status had to reapply for exempt status. So it bombarded the IRS. They had so many applications for organizations either to be first-time recognition or to get reinstated. So last year they had about 74,000 applications that were pending, and 55,000 of them were over 275 days old. That's like 9 months old. They haven't even looked at it yet. So they were able to process 91% of their old inventory, and now they have about 20,000 sitting in inventory, and it's not as dated. So they're happy that they're getting caught up and moving applications around. Then with your Form 1023-EZ that I mentioned earlier, that's where you're filing for exempt recognition, but you're doing it online. Well, they got some people were a little bit concerned about this online recognition, and they had queries over to the IRS saying, how are you monitoring this? You're not asking for their articles of incorporation. You don't want their bylaws. You're asking for minimal information and awarding exempt status. You're letting them have it. So what they're doing right now, they're doing correspondence examinations for the organizations that received exempt status this way, and then this next coming fiscal year they're going to do more correspondence exams to make sure that people are doing what they said they would do, they really qualify, that type of thing. So Treasury and Capitol Hill. The priority guidance plan, what that is, it's a kind of a wish list on guidance and regulations that they'd like to issue, like regulations, announcements, things like that, rev procs, all sorts of things. So on the list that's relating to the exempt org area is updating donor reliance on criteria, final regs for health insurers. They did finalize in December 2914 regulations for the 501R, clarifications of requirements for tax-exempt hospitals. And then political activities, not just for a C4 organization. They want guidance on that regulations. They want to finish regulations that they've already started. And the numbers next to this sheet are how they're listed in the guidance plan. But clarification for supporting orgs, the unrelated trade or business income calculation, how you're allocating expenses for dual-use facilities and so on, some private foundation rules. None of these are new. They just want to finalize them. Other guidance that they've issued is they've issued a notice in 2014 for the Ebola, saying that it is a qualified disaster and that the income recipients are getting is excludable. It's not included in gross income. Then they also had a notice about the ABLE Act. And with the ABLE Act, this is actually, I think, a great thing. It creates a tax-exempt savings account for eligible individuals with disabilities, similar to a college savings account. So the assets that are in this account for a disabled person, it doesn't count towards their eligibility for Medicaid or supplementary Social Security income, as long as it stays under $100,000 for the Social Security. So that's a great thing. They can have some money and not lose all their benefits. There was also a notice about charter schools, and on this one, they were basically looking at retirement systems that if certain conditions were satisfied, they would be considered a government plan. Okay, proposed and possible legislation. There's been a lot of shifting around in leadership in the House and the Senate. So on this list, 2 of the people are remaining. Everybody else is new. So Paul Ryan, he is now the chair of the House Committee on Ways and Means, and he's replacing Dave Camp. Dave Camp, he last year in February 2014, he issued the Tax Reform Act. It was a discussion draft, Tax Reform Act of 2014. Had a lot of provisions that affected exempt organizations. So he's been replaced, but there's a lot of work that was done in that area. The ranking member of House and Ways, Sanders, is staying. There's a new chair to the House Committee on Oversight and Government Reform, Jason Shavitz. Remaining is Elijah as ranking member Oversight Committee, new chair for the Senate Finance Committee, and then also a new ranking member on Ron. So there's movement there. We don't know everything they're going to do, too, so it'll be interesting. Some of the proposals and possible legislation, well, the first thing, this one did go through. It was the Tax Increase Prevention Act of 2014. It was enacted at the very end of 2014. It extended some expiring provisions that people were hoping would get extended. For instance, the capital gain property for conservation purposes, tax-free distributions from individual IRA accounts for charitable purposes, contributions of food inventory by taxpayers that are not C Corps, basis adjustment rules on S corporations making property contributions, and then certain payments to controlled organizations. As also part of this act, the ABLE Act that I talked about earlier, that was enacted. Then in 2015, the House passed the America Gives More Act. It didn't pass the Senate, but it has similar things. You'll see conservation easements, IRA rollover, food inventory, but it contained 2 new things. And the new things it contained are interesting because they were in the 2014 tax discussion draft. So we're starting to see some of the provisions within that act are being actually in proposed legislation. So one of them was the private foundation excise rate to 1% and then extending the time to make a contribution deduction. The Joint Committee on Taxation this chart is just showing the revenue or reduction of revenue to the IRS based on these provisions over a 10-year period. And yes, so I think at the very bottom are the 2 new provisions. So again, the charitable contribution, people can make a deduction by April 15th, kind of like an IRA, and have it count towards the previous year. So next polling question. There is no right or wrong answer on this, but if you make a charitable contribution, by making a charitable contribution until April 15th counted in the prior year, what do you think? It would lessen incentive for year-end gifts because they can wait, cause major changes to your budget actual contribution revenue, create additional work to the charity because now you have a new cutoff of 4/15. You have to acknowledge their contributions. It's good overall because donors have flexibility. None of the above are different options. So we'll wait another second and be sure to answer so you can get your CPE. Okay, let's go. All right, so everybody's kind of all over. That's actually what I thought would happen. Okay, great. Okay, some of the other legislation that's out there is, I'll call it the Sports Act. And what this would, it precludes exempt status for professional organizations that have gross receipts in excess of $10 million. And then Trafficking Act, this would permit tax-exempt nonprofit organizations to receive grants if they're combating human trafficking. Stop targeting political beliefs. This one is, it would prohibit the IRS, it would make them, prohibit them from modifying the standards of determining whether an organization qualifies for exempt status. So this all relates to the Tea Party where they really scrutinized organizations getting exempt status. The IRS Notice Act, this would require the IRS, the House version is, it'd require the IRS to provide organizations with a notice before they automatically revoke their exempt status. And then the Senate actually adds on to that saying, hey, if the IRS didn't inform them correctly, they can retroactively reinstate them because the IRS didn't follow the rules. Paying a Fair Share Act, this would require high-income taxpayers to pay a minimum tax rate of 30%. If their income goes over $1 million, it'd be 30% on adjusted gross income less charitable contributions. Then the next two you see, they're still trying to get permanent. The S Corporation Contribution Act, that was extended, and conservation easement. So those still stay on the radar. Sunlight for unaccountable nonprofits, this would require information returns from exempt organizations have to be available in a searchable format so that they can identify the contributors for certain organizations. Then last thing I want to talk about is the proposals and possible legislation based on the President's budget. And the first one is modifications to the new markets tax credit. They would want to make that permanent, and the credit would be allowed as an offset against alternative minimum tax. Also, they'd like to reform the low-income housing credit. The 20% itemized deduction limitation would be for high-income taxpayers. The fair share tax is similar to the one I talked about before. The other one was an act. This one is a tax, and it's 30% of adjusted gross income less charitable credit up to 28% of charitable itemized deductions. So it's a little formula where they're getting more money out of what they call high-income taxpayers. Elimination of the deduction for charitable contributions that are prerequisites for purchasing tickets to sporting events. So what this one is organizations or people, if they had rights to purchase tickets, they would get an 80% deduction as a charitable contribution, so they want to take that away. Modifications to conservation easements are on there. Electronically filing is, on that one, electronically filing, they want to make it mandatory for all tax-exempt organizations, and there would be a penalty of $5,000 if you did not electronically file. And the 1.35% excise tax on private foundations, that would be the flat rate. Right now, private foundations have either a 1 or 2% tax rate on net investment income. So this one is saying a 1.35. That rate's been out there, talked about for a while, and taking away the 1 or 2. The discussion draft of 2014, that one had a 1% rate. So there might be a change in that, and that would be really an improvement for the private foundations. The change in the contribution limit and carryover, what that would do, for the contribution limit, only right now, if you make a contribution, it's limited to a percentage of your adjusted gross income as an individual. So we call them typically a 50% limitation for public charities. They'd say cash only would meet the 50% rule for public charities, only public charities. Everything else, no matter what, for all other organizations, private foundations, non-cash contributions, it would be a 30% limitation. And I do want to go back because I skipped one on the, where is it, modifying the Form 1098-T reporting. I want to mention that. What they would want is higher education institutions, they would require them to report the amounts received for qualified tuition and related expense on the Form 1098-T Box 1, eliminate the option to report the amount billed. And then another thing, this is new, they would require any entity that's issuing a scholarship or a grant in excess of $500, adjusted for inflation, that is not processed or administered by a higher education institution, they have to report that on a 1098-T Box 5. So that wraps up my side. I'm going to turn it over to Emina.
Great. Thank you, Patty. Some current developments that is happening with us right now is I'll jump into the colleges and universities compliance report and kind of what their findings were. The main thing that resulted is an aggregate increase to unrelated business taxable income of approximately $90 million, which, yes, that sounds like quite a bit of an increase. Primary reasons for this increase were improper reporting of losses is unrelated business income, UBI, errors in computation of substantiation regarding the NOL's net operating losses, which resulted in a disallowance of nearly $19 million in NOLs. And then lastly, misclassification of certain activities as exempt, but should have been unrelated activities. As Patty mentioned, this report took quite a bit of time from the IRS, and they issued preliminary reports and then the final report and use that data to modify what they will do going forward. So the next steps is to look at UBI reporting more broadly. In particular, they identified that they will be looking at recurring losses and allocation of expenses. Another item they mentioned is they also would like to issue some guidance to taxpayers and practitioners regarding allocation of expenses and just better help define how to do it and what are some of the permissible methods. What they're seeing is inconsistencies, and they advise that you pick a method for allocating your expenses and then stick with that method. Consistency is really key. Then if you, and most of these colleges and universities, how it all started out is with an IRS compliance check questionnaire. And some colleges and universities did not reply, others replied, and the key is that make sure you accurately answer and reply to the IRS. it's not really optional. And also, if you have inaccurate responses or they just didn't seem right to the IRS, it could trigger IRS audits. So watch out for that. All right, polling question. Have you ever been contacted by IRS with a questionnaire? Yes, no, or not applicable. I'll give you guys a few minutes, probably about a few seconds, and then feel free to answer. And then I'll close it up. Okay. No. Looks like a majority of you have not received them, and a few of you have. So just make sure you respond back to them, and make sure you also, if you'd like, you have your CPA also help you out with that, answering the questions. And then some of you are not applicable. So, all right. And then here's some of the links. Here's the interim report, the final report, and then a questionnaire, a sample from it, and then the IRS remarks as to the final report. Switching gears to kind of discuss some of the private letter rulings that the IRS has done recently. And the first item was that income realized by an exempt museum for gift shop sales of toys, books, and documentary videos held as not UBI because it relates to exempt purpose of providing education pertaining to outer space. And that has been somewhat of a hot topic for museums. And so this kind of provided some relief for a good chunk of them. Another item that the IRS has been dealing with and several court cases have addressed is conservation easement deduction and values. And it seems to be a very big hot topic for a lot of the IRS in general and all the laws. As you may have noticed, conservation easement has popped up quite a bit as to what they're looking into. And then just kind of a final tip on when you're doing your exempt application is don't add consulting to it because it makes it sound like commerciality. And there have been quite a few private letter rulings in cases that have discussed commerciality in general. And usually commerciality means that you operate it as a business. You're trying to make as a for-profit business, and so usually that's an indicator for unrelated business income. So just watch out for that when you're doing your applications. Another item that they have been very focused on is private inurement and private benefits. It's a very big hot topic, and as Patty mentioned earlier, it's one of their items that they are looking at and are very concerned about that people are getting benefit that they shouldn't. So just watch out for those types of situations. And another item is for 501c6 entities, organization of physicians and other medical professionals held not to qualify as exempt business league because its primary activity, which was negotiating managed care contracts on behalf of its members, primarily benefited membership rather than promoting the line of business. And in the parentheses, I've listed several of the private letter rulings that have addressed this. And it's a big issue with them that just make sure your 501c6 clients or you yourself are not just benefiting your membership rather than promoting the line of business. So just watch out for that. And then 501c7, there's numerous private letter rulings about that, where clubs lost exemption due to excessive non-member income. So just make sure that you're not diluting your member income too much. And just another key item that the IRS is really looking at is that there's general agreement that private inurement is a subset of private benefits, so you'll likely see both of them at the same time. So just keep that in mind. And then Another item that they're obviously very much looking at is, I'll skip the second one that talks about the pursuit of social justice and legislative action. So make sure you just have a very legit exempt purpose that you can actually accomplish without getting legislative action. And then another that talks about exemption is social welfare organizations have been doing quite a bit of political campaign activity, which per this particular one, 60% was first-year revenue and 87% was in the second year, which that's a very high percentage. And so just make sure you don't do too much political activity if you're in that situation in your social welfare organization. Okay. Switching gears, there's quite a few developments that have happened over time, but just there's too many to list, and so I just kind of focused on just a few that we've seen or focused on. So the IRS this year has done some Form 990 changes and issued some clarifications on some of the particular schedules this year, and just the core Form 990 as well. The first item I would like to mention, and that is always, of course, compensation Part 7, deals with clarification that reportable compensation should not be treated as deferred if the income was within, basically received within 2.5 months after the end of the calendar year, ending with or within the tax year. So that's a short time frame. The IRS does not consider it as deferred, so it's considered current. And then the one other item, which has been kind of a hot topic with them too, is deferred compensation in general. To be reported in column F is it does include compensation that is earned or accrued in 1 year and deferred for future years, whether or not funded, vested, qualified, or non-qualified. And in particular, this addresses 457B and F plans. So just make sure that you're asking and reporting deferred compensation arrangements when you have a 457B or F plan. A major change that happened this year is to Schedule A, and it relates to supporting organizations. They added several new parts. So Part 4, Section A is for all supporting organizations. Section B is for Type 1 supporting organization. Section C is Type 2. Section D is Type 3. And Section E is Type 3 functionally integrated. And Sections B, C, D, and E are fairly small questions, not as much. Section A has a few more questions. And then the biggest change, I'd say, is Part 5, Type 3 non-functionally integrated supporting organizations. And I've attached one of the Schedule A changes that looks at the new form, the 2014 form Schedule A, for you to take a look over and see what the differences are. And you'll see that it's quite large and it's been expanded significantly. And Part 5 has a couple of pages that looks very similar to a Form 990 PF, and it has similar distribution requirement provisions as in that form. So you'll see quite a few similarities between that particular section and part of the Schedule A and to a 990 PF. So just be aware, lots of questions, several more disclosures needed than in the past. So those were the largest changes this year. Some other changes is that organizations can check multiple boxes on Schedule A. For instance, you can check the box for Schedule H, but then you can also complete Schedule A Part 2, which could possibly eliminate how many contributors you list on Schedule B. That then corresponds with if the contributors are reported on Schedule B, then you may not have to disclose transaction or for Schedule L because of substantial contributor rules, which I'll just talk briefly about in the next few slides. And then our last polling question is, Does your organization currently select multiple boxes on Schedule A? I'll give you a few seconds to select your answers, yes, no, or not applicable. Excuse me. Okay. Look at the results. All right, mostly no, and a few have selected yes, so that's very good. Good, good. Just be aware that you can definitely select the multiple boxes if it's applicable to your organization, and you can definitely eliminate some disclosures that you may need to do. The other item that I'd like to mention is Schedule L, and with some additions. Schedule L instructions for definition for interested persons. They have taken a more uniform approach and applied definitions for Part 2 and through 4. There has been no change to Part 1, which is good. And they have expanded Part 2 through 4 to include creator or founder of the organization and their family members. And then this also includes sponsoring organizations of FIBAs. They've also expanded Part 2 through 4 to include substantial contributors reported in Schedule B and their family members. So now you can see how Schedule A and Schedule B and now Schedule L kind of interlink better than what they've done in the past. And they all kind of flow into each other. And then lastly, expanded Part 2 to include 35% controlled entities. Some of the Schedule L removals is definition for interested person is removed from Part 2, highest compensated employees, in Section 4958, disqualified persons. Removed from Part 2, contributing employers of FIBAs, and then removed from Part 4, entity of which a current or former officer, director, trustee, key employee, or any family member thereof was serving as a director, officer, or trustee, or a partner, member, or shareholder with a direct or indirect ownership interest in excess of 5% in a professional corporation or entity traded as a partnership, and then removed from Part 4, non-stock organizations more than 35% controlled by other interested persons. I'd say some of the removals are a relief, and then obviously some of the additions might add a little bit more burden. So some other things for Schedule L that you may notice is for Part 1, they are wanting you to identify the organization's manager or managers, if any, that knowingly participated in the excess benefit transactions. And then they clarified that split dollar life insurance arrangements are loans that are reported here. And then finally, they added an exception for transactions with publicly traded corporations in the ordinary course of business on the same terms as generally offered to the public. So I'd say a few things they've definitely done a good job clarifying better, and then a few things that they've definitely added that might take a little bit more work. At this time, this concludes our presentation, and I'd like to open it up for questions and comments at this point in time. Pam, I turn it over to you.
Yeah, and actually, thanks, Emina, and thanks, Patty. We have received a couple of questions in the Q&A inbox, and I think the first one that I see, Patty, I think this one was part of what you presented. Someone had asked, how does a user access the business master file extract information that you referred to on slide 9?
Oh, that's a great question. You know, I have it as an automatic link. I think I would probably just go to irs.gov and search Exempt Org's Business Master File. And if you can't find it, email me and I'll send you the link I do. But they have it out there. But again, you want to find all of the reference to what the columns mean. And it's got a lot of data in there.
Thanks, Patty. There's another question on here. Do you think the IRS will move from correspondence examinations to in-person examinations in 2015? If not, when do you think they will make a change?
I'll respond to that one, and then Emina, you can chime in if you'd like. But they like to start with correspondence examinations right now. That's their method, and a lot of it is because of personnel. They don't have the manpower to get individuals out there to do a lot of examinations. And since they're going to an analytical approach, the more correspondence exams, they can get a lot of feedback from a lot of organizations, compile that, and then decide if they want to come examine you. If they do, a person will be there, I guarantee it. You don't really want them there. And like Emina said, if you get a correspondence questionnaire, you should contact your tax professional and let them know, and maybe they can help you respond to it so you've done it accurately to the best that you can to avoid the next step.
Yeah, and I agree. They do like correspondence examinations. They're much easier for the agents as well. I've had one IRS agent first initially request an in-person examination where they wanted to come to the client site, and we were able to first we tried to reschedule, but then she was like, well, we can just do it over correspondence and fax information. I can just send you all the request items instead. And she much rather actually preferred it that way too. So I think to their budget constraints, they've had that, if they don't have to travel, it'll be much easier for them too. So, but like Patty mentioned, yes, it'll help them with the data analysis for sure. So, yeah, do I see them doing more in-person examinations in 15? Likely not. They'll probably do a lot more correspondence examinations than in-person.
Great. Thank you both. Here's another question. How do you think the IRS will react when the new NFP reporting standards are adopted?
I think they're talking about gap reporting requirements. So I'm not quite sure if I'm answering right. If we are talking about the gap changes, I don't know how much the IRS will really react to that. So I'm not quite sure I have the right response. But they've already redesigned their Form 990, and they had a lot of work to that got released in 2008. And they don't have the money to really make any big changes. They can make maybe slight changes. They might add a question. So I'm not really sure how they'll react.
Emina, I think this question might be related to your presentation. Here it is. Why on Schedule A does it say only check one box?
Yes, the IRS likes to provide conflicting instructions on the actual forms themselves and then with the instructions, but you can definitely check more than one box. It's very common with the IRS. Patty, I'm sure you've seen the same in other parts of the 90. So that's
all the time.
Really what it is. Yeah. So that's what it comes down to is, yes, very conflicting, and it's always a work in process.
Great. Thanks, Emina, and thanks for clarifying. Someone had asked, are there any significant changes on 990T?
I'll answer that. At this moment in time, the IRS has stated no significant changes. They did express that they have a desire to definitely expand the 990T and to revamp it a little bit, just like they did with the 990. But at this point in time, they have budget constraints whereby they don't have and don't foresee much change at this point in time, and just generally no real changes to the 990T this year.
Great. And then I don't know if either of you know the answer to this one. Do you know when California will allow for e-filing?
They actually allow it now for the 199 form that's filed. It's not allowed for any unrelated trade or business income activity, Form 109. And also the Attorney General submission, the RRF-1, is a paper submission. So only one of the forms can be sent in.
Thanks, Patty. And then I'm not sure if you can help with this question. What are the proposed regulations under 501c relating to political activities?
Proposed regulations. I think that might be in reference to priority guidance plan. Yeah. So what that is, I haven't read the actual regulations that they have right now for the C4 organizations. They did issue in 2013 regulations for political activities for the C4s. What they're trying to do is issue regulations and guidance for the C3s as well, so outside of the just C4. So they haven't issued them yet, and I haven't read anything on what they're thinking about. But basically, it's more clarification for us, which is a good thing. So the C3s know the rules better. Emina, have you seen anything on it? Yeah.
No, I've not seen, but
Okay.
I definitely agree with you. Nothing yet.
Thank you both. I think we still have a few more minutes, and we still have a couple of questions that came in. Concerning the expanded reporting on Schedule L, Part 2, to include substantial contributors, is this the disqualified person's definition of substantial contributors?
I would say yes, it is.
Yes. Yes. Mm-hmm.
Great. And then another question on e-filing. Does e-filing increase the probability of examination?
I'm going to say no, not necessarily. The probability of examination is an unknown, honestly. So we've tried to e-file as many returns in our office, and we have certainly not seen an increase in examination whatsoever. So just from personal experience, I would say no. Patty, I'm not sure if you've seen the same.
Yeah, I don't think it matters. I think the e-filing just allows them to extrapolate data and do their data analysis better, but I don't think it automatically triggers an audit higher or lower.
Thank you. And I think one other question. When do you think the IRS will make a decision on the 2012 1098-T SSN TIN penalties?
I don't know. Hopefully soon. Haven't heard. They didn't talk about it.
Okay. And then just one last question, I think, one more that we have time for. On slide 29, you mentioned modification to LIHTC. Can you elaborate on that?
That would be for let me find that, slide 28. Okay. That is your low-income housing credit changes. I have not read the exact changes, so I can't elaborate, but I think, do we have email access, Pam, that we could get a response back to the person that asked that?
Yes, absolutely, we can. We can follow up on
we can send you something, so I don't have a response on that one right now.
No problem. Yes, we can definitely do that, and we can follow up after this webcast. Well, I think that concludes our webcast for today. Again, thank you to Patty Mayer and Emina Cresswell, and to all of our attendees for participating in today's presentation. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet in order to receive credit. You can find that sheet in the file folder icon of the webcast console. If you participated as an individual, you should be able to view your CPE progress in the certification widget of the webcast console. If you met all certification requirements, you should see a download icon in the bottom right-hand corner of the widget window, and you should be able to download a PDF copy of your CPE certificate. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. Also, here is a link to an online survey where you can provide feedback for today's presentation. We also have a section on there, if you've got any suggestions for future topics that you'd be interested in us presenting, feel free to provide your suggestions in the survey. Your feedback is definitely very important to us. Finally, please visit our website, mossadams.com/NFP, to learn more about future webcasts, subscribe to our email alerts, and find on-demand versions of some of our previous webcasts. Thank you again for joining us, and we hope you'll join us again next time.